From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Tuesday the 16th, 3 p.m. in London, 10 a.m. in New York. We're 30 minutes into the trading day in the United States. From London, I'm Guy Johnson, Alix Steel over in New York. Welcome, everybody, to Bloomberg Markets. Alex, I'm a little confused today. I thought the U.S. consumer was on a downer right now. I look at the confidence data, doesn't look good. In fact, it's plummeting. Then I look at these retail sales numbers. I look at the numbers from Walmart and Home Depot. They're amazing.
I know.
What have you been doing?
It is perplexing. You have sentiment, consumer sentiment is lower, inflation expectations are higher. We thought this number was not going to be that great, particularly for the likes of Walmart, because that's where you're going to get hurt if you're really pinching your pennies on things like food. Not happening. So take a look at what's going on in the market. S&P is up by about 0.3%, led by healthcare, but also consumer discretionary, where Home Depot is definitely outperforming. Super solid numbers across the board. Spend money, live better. That is Walmart's a ripoff of Walmart's slogan, save money, live better. You have to wonder, are people no longer saving as much or spending down a little bit of their savings? And is that contributing to this? Now, the aftermath of that, then you have industrial production also holding up very well. And then you have James Bullard talking to Michael McKee saying, we should taper faster so we can hike sooner. And you can take a look at the 2-year automatic response yields up by about 1 basis point. So a little bit of selling in the front end. Now, irrespective of this, I just want to highlight natural gas. Natural gas futures here and over in Europe are very, very high today because Nord Stream 2 seems to be caught up in a procedural delay. The reason why it's also so important is because that's going to feed through to the sentiment and inflationary picture. And then do consumers start to care? I don't know. We'll break that down through the next couple hours, Guy.
There's a couple of big stories that I'm really watching, one of which is Peloton. We're getting the details of the offering, the secondary. That's coming through onto the tape right now. And the biggest story to me today, Rivian. Rivian is now worth more than Volkswagen. I find that number absolutely amazing, that we've gone so fast and really kind of overtaken some of the majors in the auto industry so quickly. We'll talk about that as we work our way through the next couple of hours. Let's talk about some of the biggest stories we're focusing on right now, though. Anne-Marie Jourdain is at the White House. President Biden's pick for the Fed chair. When are we going to get news on that? Damien Sassa has the takeaways from yesterday's virtual summit between President Biden and President Xi. Olivia Rockman is looking at how the U.S. consumers, as we've just been discussing, are opening their wallets. Retail sales numbers up for a third month in a row. And Senate Banking Chairman Sherrod Brown talking about the fact, Alex, that the White House pick for the Fed is, quote, imminent. That is the story I think we really should be starting on. Jim Bullard spoke to Bloomberg earlier as well on this leadership story that we're all focusing on over at the Fed.
No matter how this comes out, there'd be a lot of continuity in Fed policy. Both of these players have, long track records at the Fed. So certainly it's a big committee. Also, I think people have to keep that in mind. And there's a lot of experience on the committee. So I think we'd see continuity.
We don't know what's going to happen. To be honest, if you read through the Sherrod Brown statement, he's not even clear a decision has been made. Let's go to the heart of the matter. Bloomberg Washington correspondent Anne-Marie Jourdain outside the White House with the latest. Is there any latest, Anne-Marie?
There's not, but Guy, to your point from Senator Brown, if I could bring you the full quote, he says, I hear it's imminent. I'm not going to speculate who I think it might be now. I assume the decision's been made and they haven't announced it, but I don't even know that. So I'm not quite sure he's a good enough timeline for when we're going to find out who the president is deciding and whether or not he's going to reappoint Jay Powell to stay in that top spot or potentially elevate Governor Brainard. What we do know is the president said he would be making his decision very soon. And of course, the Wall Street Journal yesterday was reporting potentially as soon as this week. Definitely many are speculating it's going to come before Thanksgiving, because remember, we have to then go through a Senate process. And there's about 2 weeks left in terms of working days for lawmakers in the House and in the Senate, and they have a very big to-do list. But we still are waiting, of course, from what the president will say regarding the Fed. And it's not just that top position. Potentially it's others. And there's one other thing I think we should keep in mind. this does seem to be a little bit slower than former administrations. And when we learned from the Wall Street Journal that in that interview between the president and Chair Powell and Governor Brainard, there's only one other individual, and that was Brian Deese. So it does seem like this is very centralized between the president and his economic advisor, Deese, and there's not like a big committee to be deciding what the potential new Fed could look like.
Yeah. Also, imminent in D.C. and imminent for the rest of the planet is different. Emery, thanks a lot. Bloomberg's Emery Herdern joining us outside the White House. In the meantime, President Biden was very busy yesterday with President Xi. They agreed to keep talking. The leaders of the two largest economies in the world held a virtual summit last night that lasted longer than expected. Damian Sassower of Bloomberg Intelligence has more. Damian, what did you learn?
Well, I mean, the feel-good vibes are there. I mean, look, you had President Xi referring to President Biden as my very good friend. Good to see you again. A pragmatic approach, forming common guardrails. But really, it's all about the economy, Alex. I mean, this is about getting the removal of tariffs so, President Biden can get his domestic house in order to keep inflation pressures from spiraling out of control. And in the case of Xi, he needs to get growth moving in the right direction. I mean, we're calling for 5.8% year-over-year growth next year, ahead of the party Congress, where he hopes to secure a third term and be leader for life. So, this is really more about the economy. And for me, if you just look at the price action today, I mean, look, you see dollar yuan weakening off the news ever so slightly. And certainly you would have thought to see the 5-year credit default swap spread for China come in, and it's actually risen and widened a little bit, which is kind of interesting to me. So, the markets are sort of still trying to digest all this, but the feel-good vibe is there for sure.
Yep, which is going to be interesting to see how we work our way forward on this, Damian, because there's a good feel to the discussion, but I didn't feel there was a lot of concrete stuff coming out of it. Maybe when we get to the concrete stuff, the feel-good factor starts to ebb away a little bit. Damian Sassower of Bloomberg Intelligence, greatly appreciated as ever. Let's return to the conundrum of the morning. U.S. retail sales jumping in October by 1.7%. That's the most since March. That's despite the fact that we've got the fastest inflation rate that the United States has seen in decades. A lot of this is going to be inflation. Consumers, though, if you take a look at the sentiment figures, they're feeling pretty downbeat right now. So how do we tie this all together? Olivia Rockman joining us now to give us that take. What is your kind of assessment of where we are? How does the consumer sentiment story fit with the retail sales story, fit with the inflation story?
So in these retail sales data, there are really two things going on. One is that we're seeing strong gains in categories like e-commerce, which reflects spending at Amazon for the holidays. We're seeing strong gains in autos and gas, basically across the board. So that would imply that the consumer is still spending. However, these data are not adjusted for inflation. And so it could just be that these higher gains in certain categories are only because the prices are higher. Take autos, for example. So what will be really interesting is to watch next Wednesday when we get personal income and spending data, which are adjusted for inflation, to see if those square with the number we got from retail sales today. We'll also get some interesting earnings from retail companies, which might give us a better gauge on where holiday sales are going and also if consumers are reacting to some of these price increases.
Yeah, exactly. And also, did people buy earlier in the holiday season because of all the supply chain problems? Olivia, thanks a lot. Really appreciate it. Bloomberg's Olivia Rockman joining us there. Let's look at the other conundrum then. And that's what happened at Walmart and Home Depot. They had earnings out earlier today. Super solid. Abigail Doolittle is looking into those reports. Abigail, Walmart's getting hit a little bit on some margin worries there, but walk us through the numbers.
Well, it is interesting because we have this very mixed reaction between these two big box retailers. You can see Home Depot absolutely soaring, up 4.4%, up more than 40% on the year. Walmart, on the other hand, as you were just mentioning, Alex, down 1.8% because of margin concerns. However, if we look at the quarter for Home Depot, or excuse me, Walmart first, we're going to see it's a very strong quarter. They beat, they raised, their comp, their same-store sales number came in at 9.2% versus the estimate of up 6.9%. They raised the range. This is the third consecutive earnings beat that you have, so some strength there. And again, U.S. comp sales now seen up 6%. They're raising. So it really seems as though perhaps investors, traders worried about what will come next. Will they continue to manage costs well? It seems as though Americans are going to this store to some degree because of the lower prices, but the margins, that is the concern. As for the strong quarter, Home Depot, they beat, they raised. This is the 29th out of the last 30th quarters where they have beaten. But the interesting thing is, through the pandemic, this will will be the first time that this stock may, in fact, rise. We've seen over the last number of quarters the stock down. And in fact, for the last quarter in August reported down 4.3%, again, despite beating. But it seems as though investors, traders, Guy, really like this one. And the trend of wanting to fix up the home, it's still in place.
Absolutely. Hardware stores are almost kind of right at the top of the list in terms of my favorite places. So much fun. Gotta love it.
I agree with you.
You could spend an absolute fortune in there, but you've got to fight the contractors because they're in there buying everything up at the moment. Trying to get hold of a piece of wood right now, really tricky. Yeah, Alex is going, She spends a lot of time thinking about lumber prices. Abigail Doolittle, that was... shoes, lumber. Yeah, exactly. I know exactly which way we're going to come down on that one. You need the lumber to build the shoe cupboard. That is certainly true. What are we going to talk about? Yeah, there we go. We finally found it. What are we going to do next? Equity investors feeling pretty bullish right now. Goldman Sachs is amongst them, boosting its S&P target for year-end 2022. Where are we? 5,100, upping the European story as well. Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. Up next, this is Bloomberg.
The challenge is if we overreact by saying, let's just change the path of monetary policy to try to deal with a one-time effect, that could lead to a worse long-term outcome for the economy.
That was Neil Kashkari, Minneapolis Fed president, speaking earlier about inflation. Now, this is the day that we all love. It's the Bank of America Fund Manager Survey, where we get a read on what clients are actually doing in the market. And this read was very different than the previous month, saying that clients are convinced inflation is transitory and expect the Fed to remain well behind the curve. And you can see that in where the asset allocation is. I mean, global fund managers have the biggest overweight in U.S. equities since August of 2013. Also a favorite, emerging market equities, as well as Bitcoin. Those are three things that you're probably going to want to invest in if you think that inflation is transitory, as it seems like fund managers are now playing like it is, Guy.
Absolutely. And there does seem to be a single narrative that is working its way around the market. It has been for a while. Buy stocks. That's where a lot of people are allocating money. Do you allocate to Europe? Do you allocate to the United States? Do you allocate to emerging markets? I wonder if that's the more finely balanced decision. The decision on stocks feels like everybody's on board with that one right now. And we ain't done yet, apparently. Goldman Sachs expects the S&P index to rise by 9%. That'd take you to 5,100 by the end of next year. They've got a pretty positive call on Europe as well. Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist, joining us now. Peter, great to see you. People are looking into next year, trying to figure out exactly where stocks are going to go. You guys are at 5,100 for the S&P. What gets us to 5,100 by year-end 22?
Well, I think there are a couple of things that really supporting a still positive view on equities. One of them is that the economic cycle is still intact. It's slowing from the pace this year. Globally, GDP growth this year was around 6%. We're expecting 4.5% in 2022, so still above the long-term trend growth rate, and even at around 3.5% into 2023. So as long as the economic cycle continues to expand, we would expect profits to be growing, and that's the principal driver of returns in equities. But the other important point, of course, is that as you have been discussing, inflation is picking up, policy rates remain at all-time record lows, real interest rates are negative, and that's pushing investors understandably into real assets. Bear in mind that the dividend yield on equities is still pretty positive, and the corporate sector is very cash generative. So this is really a real yield, and I think that's what's really driving the continued push higher in equity prices, albeit at a slower pace.
So, Peter, if that's the case, is it still going to be U.S. equities, emerging markets, or is it going to be time for other areas? And in that, are bonds a hedge anymore for these rising equity prices?
Well, two really good questions. I think the first thing is context. The last cycle after the financial crisis was so dominated by the US equity market outperforming. And that really reflected two things. Firstly, greater success in the US economy than elsewhere. And secondly, the great success of the growth factor and in technology companies in particular, which were very heavily represented in that index. Other indices, particularly those in Europe, were much more heavily exposed towards troubled value sectors, banks, energy, and so on. As we move forwards, we find that the profit growth differences between the US and other markets are likely to be narrowing. Technology is still doing well. It's becoming a bigger component of other markets like Asia and Europe, but also the very troubled areas are no longer facing the same kinds of headwinds. And actually, they've been the areas where you've seen the biggest profit recovery this year. So overall, we would be arguing for much more diversified geographical exposure. We don't think the US is going to do poorly, but we think that there are good reasons to be less geographically specific and more diversified as we move forwards in time.
So Peter, to that point, we're going to get to Europe more specifically in just a second. But in terms of then hedging it, is it going to be bonds? Is it gold? Is it Bitcoin? What is it?
Yeah, well, bonds are not a particularly good hedge, I think, now. Again, if we look back at the last cycle and even over the last 20 years, you've seen an exceptional period of returns in the sort of 60-40 equity bond balanced portfolio. And that's because both major financial asset classes have done extraordinarily well as interest rates have moved towards zero. But also in the periods of time when equities were facing stress because of recession or fears of deflation, bonds were a great hedge. I think as we move forwards, given we're at record low historic bond yields, it's difficult to see the same kind of returns. In fact, we'd be expecting negative returns in bonds as we move forwards in time. So it's not a great hedge for a higher equity weighting. And so cash probably represents a much better way of hedging against an increased exposure to risk assets like equities and other risk assets and real assets as well, like commodities, where we've been structurally positive.
Peter, let me make the pivot to Europe. Alex brought it up. You've been talking about it. I've got a chart here. It's the stock 600. We got through 490 a little bit earlier on. We've retreated a little bit, 489. But this is a long-term chart, and you can see that European equities have been moving up. They've underperformed broadly what we've seen in the United States. We're only really starting to play catch-up. So that's the kind of context. 489. I think you are kind of you're expecting further gains next year as well. But the key question, I think, is this one here, which is a fantastic chart at the moment. The European discount to US stocks is at a record. We're at a 30% discount, Peter, on a forward PE basis. We've been traditionally kind of 20, 25. Throughout my entire career, I think we've been in a situation where that discount has existed. But we're now at 30%. What does that tell you about the story for next year? Do I want to make that pivot to Europe? Is that discount going to continue to widen? What do you expect?
We expect the discount to start narrowing. We have to be careful with valuation because there's been a big valuation discount in Europe relative to the US for a long time. And one could have made the story that would have created an opportunity for European outperformance. It didn't happen, but that's mainly because the fundamentals didn't support it. The last cycle was so dominated by growth outperforming value that the markets that were heavily weighted in the growth factor, the US in particular, with its especially high weighting in technology, was outperforming, and the falls in interest rates were supporting longer duration assets. But I think as we move forwards, this record discount does make a difference because the fundamentals are shifting a bit. The value areas of the market are likely to benefit more if we do get higher inflation or bond yields. Steeper yield curves help, for example, banks. Higher commodity prices help energy, resources, and so on. And also, we're not seeing the same negative drag on European economic growth moving forwards. In fact, we're looking at well above trend growth in the European economies next year, pretty similar to the US. So I think that discount is probably too big. It's also worth mentioning that even if we adjust the two markets, the US and Europe, so that they have the same sector exposures, Europe still trades at a record discount. So I think that for people who are looking at value, are looking at some diversification, Europe is a good place to be. And actually this year, for the first time for well over a decade, it's roughly held up with the US, you know, achieving mid 20% return so far. That's
Peter.
pretty decent, particularly when it's still got quite a low weighting in technology.
Peter, a great insight. We have to leave it there. Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. We appreciate you joining us today.
Okay, Peloton.
Coming up.
Go. Hey, Sandra in Munich. 50
We'll talk
rides.
Peloton. This is Bloomberg.
Okay, let's get into gear. Peloton kind of gear. The company is coming out, slashing its revenue forecast, remember, and it is now coming back to the market with a secondary. Let's get the details now. Dave Wilson, over to you.
Well, thanks, Guy. I mean, yeah, we found out Peloton was looking to raise $1 billion by selling shares, and it turns out they ended up selling $1.1 billion, which tells you something about why the stock is up today. You also have to look at what's happened since they came out earlier this month and talked about what their outlook was, and people didn't like what they heard, that's for sure. And the shares fell 45% in 7 days. So they were a whole lot cheaper than they were before those projections came out. Still up, though, 59% from the price at which the company went public a couple of years back. And maybe people saw the opportunity to kind of step in and buy at this point. It sure looks that way, I mean, given the rebound that we've seen in the shares today. And let's face it, Peloton needed the money. They went through about $650 million of cash in their fiscal first quarter. They ended the quarter with less than $1 billion when you figure in cash and equivalent securities for the first time in 9 quarters. Heck, the chief financial officer, Joe Woodward, said on the conference call after the earnings came out, we don't see the need for any additional capital raise based on our current outlook. Clearly something changed in the past 2 weeks or so, and now you have Peloton selling stock.
Quickly, Dave, what about the sub numbers? What do they look like?
Well, I mean, you're seeing growth still, not quite so fast in terms of subscribers, but other indicators, not so great. Total revenue falling at a faster pace, quarterly workouts down from where they were a year ago, and a similar story if you look at them on a monthly basis. Not down quite so much, perhaps, but certainly all this kind of pointing to, stay-at-home company, Peloton, and people aren't staying at home, and it's showing up in the numbers. And so now Peloton's responding with a share sale.
Yeah, I mean, it's getting cold. I don't know. I may want to stay home. Dave Wilson, thanks a lot. I'm Bloomberg's Dave Wilson joining us there. All right, coming up, Russia's Nord Stream 2 pipeline faces yet another delay. We're going to break that down, plus the global LNG market with Sharif Souki, Tellurian executive chairman and co-founder. This is Bloomberg.
So this is feeling increasingly familiar. European gas futures jumping sharply today. This after the regulator in Germany suspended the approval process for the Russian gas pipeline Nord Stream 2. Joining us now to talk about this, Isis Almeida, who leads gas, power and renewables coverage here in Europe. She appears on this set almost as much as I do these days, probably even more. This is certainly the story of the moment. Let's talk about what is happening here. Why is this happening? You came on and explained it to me beautifully. Basically, the idea is you can't own the gas and the pipeline. So what Gazprom is having to do is put the pipeline into a separate legal entity, but that's going to slow down the certification process.
That's right. And Gazprom had already tried doing that when it set up Nord Stream 2 AG in Switzerland. But it turns out that the Germans basically investigated and looked into it, and the regulator said that there isn't a way of doing that unless there's an entity set up in Germany. So that's exactly what they are trying to do now. Nord Stream 2 AG, which is set in Switzerland, is now going to open a German subsidiary, and all of the staff and all of the paperwork and everything will have to go to the German unit. And meanwhile, the approval process is suspended.
All right. Until when? What does this do in terms of the timeline? Because I got the head of Trafigura warning today that Europe faces rolling blackouts if it gets cold. Can we afford a delay here?
Well, it's going to take as long as it takes for Nord Stream 2 AG to actually submit the documentation. So the process was going to run all the way to January 8th. What's going to happen now, it's going to be suspended. And as soon as the German regulator has all the documents, it picks up from where it stopped. So it starts counting. We had about 2 months left. So as soon as they have all the paperwork, that 2 months starts counting again.
Okay. I think I've just about got it now. Isis, great stuff. Thank you very much indeed. Explaining a complicated story in a very simple way. Isis Almeida, thank you very much. Alex, over to you.
Okay, so what the energy crisis has now really highlighted over in Europe is the role that U.S. natural gas can play in the world. A year plus ago, there was a glut, and now there's lots of demand. So basically, LNG export terminals are now working full tilt. So now we're looking to the next generation of export terminals to really provide that kind of supply globally, whether you're looking in Asia or over in Europe. This is an LNG export commitment that goes back from August to May to June, July. And you can just see you're looking at a huge amount. About 12 million tons per annum is now contracted from some of the really big players like Tellurian and Venture Global. The reason why those contracts are important, you get the commitment, you get financing, you get to build the stuff, then you export the stuff. That's sort of the sequencing of how that goes. And since then, Venture Global has actually secured a bunch of other commitments as well. So I want to get more in depth on that and sort of what the outlook is. Joining me now, Sharif Suki, Tellurian Executive Chairman and co-founder. Tellurian is trying to build a $29 billion LNG export plant in Louisiana called Driftwood. Sharif, good to see you. It's been a while in person.
Alex, it's been great. It's great to be back here with you
yes.
in New York.
So I mentioned the fact that you secured 9 million tons per annum in terms of these contracts. So now you have to finance to build. Where are you in that process? When you get the financing?
We're in New York talking to all the banks that eventually will be part of the finance group. So it's doing what it's supposed to do. I think the fundamentals have changed dramatically on a global basis, as your colleague and you have been talking about. So the atmosphere now for financing LNG facilities for global supply are very, very attractive. So
the entire world is kind of holding their breath for when you can officially announce something because it's such an enormous project, and that's going to be huge in terms of the export facility from the U.S. Can you give me a little bit of timing?
I don't think there's any change. We intend to start construction by the end of the first quarter of next year. We're already on the site now, preparing the site to turn over to Bechtel when we can. And we'll be in construction by the second quarter. So nothing has changed. The program is still the same. Yes, Guy?
So basically you're on track. But as we've already been talking about, and it's great to see you as well, let's talk a little bit about what happens after that. Because demand at the moment is absolutely massive. You look at the situation here in Europe, you look at the situation here, over in Asia, everybody wants cargoes. Are you at the point where you think you could go phase 1 and then phase 2 relatively quickly?
No. I think that from a construction standpoint, we have to be very disciplined. It takes about 9 months per phase, and every phase is about 5 million tons. So we really can't push it faster than this. So for us to be able to deliver 27 million tons is going to take something like 6 to 7 years. We'll have first LNG in 4.5 years, but then it has to take its time.
So I just wonder, in the meantime, then, if you can't really speed it up, who are you talking to? So you've signed deals with a lot of the big trading houses. Venture Global signed deals with a lot of Chinese guys. What about you? Are you talking to Europe? Are they picking up the phone?
We're sold out for the phase 1. And then the numbers are so attractive at the moment that the rest of the plant will be built from cash flow. So we don't have an issue except how fast can we build. So in terms of being able to, looking for commercial deals, there's no pressure. We've got more demand than we can supply. For the time being, we're sold out.
Sharif, what is the long-term picture, and what is the long-term picture post-COP? Gas was definitely seen as a transition fuel. A lot of economies were going to rely on it. People are trying to work out whether or not that is still true. They're trying to understand what the regulatory environment is going to look like going forward for gas. What is your expectation, and do you think that the lack of current clarity is going to put people off long-term contracts?
I think there's a number of things that need to enter the picture and to answer your question. The first one is transitioning from hydrocarbon is going to be a lot more difficult than people expect. Hydrocarbons represent 85% of the world energy. Renewables represent only 5% of the world energy. You can see the mathematical proposition, 85 into 5. It doesn't really work. And then when you look at the growth and the insatiable appetite for energy in general from the non-OECD countries, if you put it in perspective, OECD countries with 18% of the world's population consume 40% of the world's energy. If you want non-OECD countries to get to half of that level, you need 150 million barrels equivalent, and renewables are only 15 today. So there's no conceivable plan by which renewables are going to fill the full amount of energy that is needed in order to bring non-OECD countries to the same level or to an approaching level of comfort level in energy consumption. So we can use everything we can to encourage renewables. We're still going to need an enormous amount of hydrocarbons.
So then,
and the most attractive hydrocarbon is natural gas. So the demand for natural gas is enormous on a global basis.
So I feel like what the trajectory was, and you correct me if I'm wrong in this, is that was the story a few years ago. Natural gas was going to be the bridge fuel. A lot of people invested in it, and all of a sudden there was a glut. That's what happened back in 2019. Prices were low, couldn't get a contract signed. Then that totally changed within the last year and a half, and now there's so much demand. What gives you the confidence that this time that thesis will stick?
I am looking at the demand pictures in places like China and India, and we haven't even started with the needs of Africa for additional energy and hydrocarbons. And I think the most important thing, instead of trying to put a timing on it, is the aspiration. Now that we've discovered air conditioning in China, go tell the Chinese middle class that they can no longer have their air conditioning. It is not an easy thing to do, so it's a problem for the ruling infrastructure to be able to go back to their people and say, we're going to change your lifestyle.
Right.
And this is what we're talking about today. We're now affecting people's lifestyle, and that's an existential threat.
So then what do you make of the U.S. and President Biden's energy policy? Do you know what that policy is?
No.
What do you think it is?
At the moment, it's a prayer. It's not a policy. So I think what we're looking at is we've shell-shocked in the United States because 10 years ago, we were a very large importer of hydrocarbons. And now, all of a sudden, we are the hydrocarbon superpower of the world, along with Russia. We are the largest producer of gas. We are the largest producer of oil. And we have not assumed that role that we have taken in the global markets. We have to first understand that we are no longer simply a consumer of hydrocarbon. We are also the major producer of hydrocarbon on a global basis.
Sharif, let me just pick up on that point then and ask the question from a different angle. You mentioned Russia. What do you think about Europe's energy policy right now? You talk about the US one being based on a prayer. What do you think about what Europe is doing right now? Its reliance, its increasing reliance on Russia.
It is the same prayer with a different accent. So we don't have an energy policy consistent with the needs of the world today for additional energy and the needs to deal with climate in a serious way. And that's not happen by accident. That is something that requires a lot of thinking, a lot of planning, and a lot of intelligent global policy. It's not enough to do it at the local level.
Sharif, it's always good to catch up with you. You've been in this market for so long, and it's so great to get your perspective on it. Thank you for coming. Thanks for being here. We'll catch up with you when you finally announce that financing for Driftwood. Thanks very much. Sharif Souki of Tellurian. All right, coming up, Walmart customers are not shying away from in-store shopping. The retail issues an upbeat forecast. At the same time, they warn about squishy margins. We're going to speak to an analyst who is bullish on the stock. Simeon Gutman of Morgan Stanley joins us next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Tune in to the Bloomberg New Economy Forum happening throughout the week. Live discussions amongst world leaders on topics. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. Joe Biden and Xi Jinping appeared to accomplish as much as possible in their first summit. They agreed to keep on talking without letting tensions over Taiwan and other issues derail the U.S.-China relationship. The virtual conference lasted more than 3 hours, longer than expected. In the UK, the labour market strengthened after the government's benefit programme for those out of work in the pandemic came to an end. Companies added 160,000 people to their payrolls last month. Meanwhile, job openings surged to a record high. That all bolsters the case of the Bank of England to raise interest rates as soon as next month. And it's another hurdle for Russia's controversial Nord Stream 2 natural gas pipeline. Germany has halted the certification process needed before the link with Russia can start operating. The move comes as the pipeline's operator has decided to set up a German subsidiary in a bid to meet EU requirements. Germany's announcement sent Europe gas prices up as much as 12%. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. Shares of Walmart dropping. Even as the retailer lifted its outlook for another quarter as we head to that holiday season. Joining us now is Simeon Gutman, a retail analyst over at Morgan Stanley, has an overweight rating on the stock and a price target of 170. Hey, Simeon, why is the stock down 2%?
It's a tough crowd out there. I don't know what to say. Good quarter, better earnings, a healthy operating income. I think the market is penalizing any blemish. So any type of miss or anything that wasn't clean. And in this case, gross margin, we called it a little squishy. It was down in the U.S. 12 basis points. But I mean, come on. I thought it was pretty expected that sequentially we're going to see some pressure because of supply chain and freight costs. And then you had Home Depot, by contrast, put up almost a perfect quarter, as if the margin issues, freight issues are not having an impact.
Yeah, I really wish you hadn't used the word squishy. It's Alex's favorite phrase. We're going to be living with this for quite some time, and you've just kind of given it some justification, Simeon. Let's talk about Home Depot. As you say, this is a company that can walk on water. It seems to be doing absolutely no wrong. As you said, this was a pristine set of numbers. Is this a Wile E. Coyote moment for Home Depot? How much longer can it carry on delivering? How much longer can it carry on raising prices, dealing with the supply chain issues? Is there going to be a point at which it starts to bite?
Look, it's the home improvement market. It's one of the best segments that we cover. Pricing is somewhat benign, so you have oligopoly. Consumers are price takers, so you can raise price. Demand for shelter, for home, is still going up. There's still pent-up demand. They have a big pro business. They've made a lot of reinvestments over the years. And so I think they're showing an ability to take cost up or take price up almost as quickly as costs are rising. And that's where I think you're going to see the fragility across other businesses. So this sector, like, we should be clear, this sector is just much better positioned than being in a competitive broad-line, multi-line retail sector, by contrast to Walmart. But we think the outlook's great for home improvement. We think it's one of the sectors that could buck the trend of what we think will be reversion in the next 2 years, where all the durable spend starts to fade as services spend starts to grow.
So is that a clean read-through then to Lowe's and a negative clean read-through into Target?
Look, we think for sure it's a good read for Lowe's. That underlying demand is good. Consumers are price taking. Lowe's is somewhat similarly positioned. I will say Home Depot has made more investment and reinvestment over the last several years. So maybe some of the comparison for Home Depot was a little bit easier. On Target, look, they have a discretionary business, especially in apparel and in home furnishing, that's higher margin, that could potentially allow them to buck the trend on margin relative to Walmart. But I think the message from Walmart is that supply chain pressures are coming. They're going to rear their head, and Target should be as susceptible as was Walmart. So I think Target has a little bit of a different mix, but we think the message is that the rate of change for gross margin is slowing for most big box retail.
Simeon, I'm trying to understand what is happening with the consumer's mindset right now. I look at the retail sales number today, which was strong. I look through the numbers from Walmart and elsewhere, and it seems as if the consumer is spending now because the consumer is worried about what is going to happen later, i.e. as we get into the holiday season. How much of what we're seeing in terms of current demand is pulled forward, and what happens when that money has been spent?
Yeah, it's a great question. You would have thought, based on the timing of stimulus, that by the summertime of this past year, we would have already started to see a slowing in some spending, especially in durables moving over to services. It's been crickets. We haven't seen any of it. It's still holding, if not some subsegments that we follow are actually growing at a faster rate that they were growing at a few months ago. There's definitely holiday pull forward. Retailers and the media have made us think a lot about buying ahead of time, supply chain shortages. Every time we see those boats lined up outside the West Coast, I think that sends more people to buy. Stimulus is going to fade, and we do think you're going to see durable spend revert. So I do think it's probably some pull forward. Fourth quarter should still be healthy. Mathematically, there's a lot of dollars, there's a lot of savings. The reversion really shouldn't start till probably the early part of next year, but that's when we could be, closer to the precipice.
Yeah, I definitely bought my Barbie dream house 2021 a little early for that exact reason. I talked myself into it. So there's also a theory that we've seen retail sales hold up because the savings rates come down, and that now that individuals have to pay more for food and gas and stuff, and they've also spent some of their savings, that spending is really going to dry up. If that thesis is true, what do you buy?
Oh, in terms of stocks? I mean,
Yeah.
So look, Walmart for us has been this bastion of calm. We've been way too early on this, but we actually thought as a bellwether for consumer spending broadly, it's actually a great conduit to invest because this was an investment year for them. They've invested in their marketplace, so they're competing in the longer tail of items more aggressively. The stock at this point has been flat this year, so it's wildly underperformed. And we think it actually grows back to its normal stated algorithm, which is mid-single digit operating income growth, which is quite respectable. That's not intriguing at this moment because we have quarters like Home Depot's where things look pretty perfect and other discretionary retailers are doing great. So I think it's a relative call that's early. It's just going to take some time to play out as we get into the early part of next year. We mentioned we like home improvement. We think that's one sector that has unique drivers tied to housing that could buck the trend. Beyond that, we still think there's still some durability for Dick's Sporting Goods, a name that is very debated in the stock market given the margin that they've earned above where they were pre-COVID. But we think that category has been more habit forming, and there's more durability to that earnings stream than the market thinks.
Sporting goods and hardware stores. Simeon, you're speaking my language.
Guy's
Thank you very much
magical
indeed.
place.
It is. Those are my happy places. Simeon, great stuff. Simeon Gutman, Morgan Stanley retail analyst. Greatly appreciated. This is Bloomberg.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. In the UK, the Competition and Market Authority will conduct a national security review of Nvidia's proposed $40 billion takeover of British chipmaker ARM. The UK has been ramping up scrutiny of deals that may affect defence. It has considered a potential veto of the deal. The International Energy Agency says the end of the oil rally that sent prices to a 7-year high is in sight. According to the IEA's monthly report, supply is catching up to demand, and changes in oil stockpiles suggest, quote, the tide might be turning. Global oil output increased by 1.5 million barrels a day last month. And Pfizer is taking a step to help coronavirus patients in 95 low and middle income countries. The company will allow generic drug makers to manufacture cheaper versions of its coronavirus pill. Pfizer won't get royalties from the generic version as long as the coronavirus is classified as a public health emergency. And that is your latest business flash. Alex, Guy.
All right, thanks so much, Ritika. So, Guy, I wonder if news like that and the therapeutics that we got from Merck to treat COVID-19 is part of why we can explain why the rising cases in Europe has not dented any sort of equity enthusiasm, right? Like every index at a record over in Europe. And is that why we're ignoring these cases?
I think it's probably one of the reasons. The other one is you look at what's happened with the UK, which I think is probably in front of the rest of continental Europe, and it's managed its way through it. You take a look at the furlough data today, the employment data look pretty good. So I think there's a kind of a sense that this can be managed, which I think is interesting. The other question that occurs to me is why is Pfizer allowing generic versions of this but not its messenger RNA vaccine? Clearly, that technology versus this technology, this is the one that you want to hang on to, because it's got greater opportunities there as well.
Oh, that's a good
so
point.
it's interesting that's happening too. Messenger RNA, I think it's going to be a subject we're going to spend a lot more time talking about. European equities on the front foot once again. We're rising, we're picking up the pace. Valentin van Neuwenhuizen is going to be joining us from NN next. We'll get his take on where this market goes next. This is Bloomberg.